How dividend stocks performed during the dot-com bubble, and what it means today. The dot-com bubble, a significant financial event of the late 1990s and early 2000s, serves as a cautionary tale for investors. While technology stocks soared to unprecedented heights, many eventually crashed, leading to widespread financial losses. However, not all investments suffered equally. Dividend stocks, often considered a safer bet, displayed resilience during this turbulent period. Understanding how dividend stocks performed during the dot-com bubble offers valuable insights for today's investors, especially in a market environment often characterized by volatility and speculation. The dot-com bubble, a brief overview. The dot-com bubble was primarily driven by the rapid growth of internet-based companies. From 1995 to 2000, investors poured money into technology stocks, particularly those associated with the burgeoning internet industry. The Nasdaq Composite Index, heavily weighted with tech stocks, quintupled during this time, peaking in March 2000. However, many of these companies had little to no earnings, and their valuations were based more on hype than fundamentals. When reality set in, the bubble burst, and the Nasdaq lost nearly 80% of its value by October 2002. High-flying tech companies like Pets.com, Webvan, and others became infamous examples of the era's speculative excess. Dividend stocks versus growth stocks during the bubble. Growth stocks, the highs and the lows. During the dot-com bubble, growth stocks, particularly those in the technology sector, attracted significant investor attention. These stocks typically reinvested profits back into the company rather than paying dividends. The promise of rapid growth led to soaring valuations, but when the bubble burst, these stocks were among the hardest hit. Dividend stocks, stability amid chaos. In contrast, dividend stocks, often representing more established companies with consistent earnings, showed remarkable stability. Sectors like utilities, consumer staples, and healthcare, which traditionally feature strong dividend payers, outperformed the broader market during the downturn. While these stocks did not offer the meteoric gains seen in tech stocks during the bubble's rise, their relative safety and steady income through dividends became highly attractive when tech stocks plummeted. Key examples of dividend stocks during the dot-com crash. Procter Gamble, PG. Procter & Gamble, a staple in the consumer goods sector, is a classic example of a dividend stock that weathered the storm. Its business model, centered around everyday essentials, provided a stable income stream. As a result, P&G's stock was far less volatile, and its dividends offered a buffer against the broader market's losses. Johnson & Johnson, J&J. Another strong performer was Johnson & Johnson. The healthcare giant maintained strong earnings and continued to reward shareholders with dividends. Its focus on healthcare products insulated it from the volatility seen in tech stocks, highlighting the defensive nature of dividend-paying companies. Utilities and REITs. Utility companies and real estate investment trusts, REITs, also performed well during this period. These sectors are known for their reliable dividend payments and were seen as safe havens when speculative tech stocks faltered. Lessons for today's investors. 1. Diversification is key. One of the primary lessons from the dot-com bubble is the importance of diversification. Investors who had exposure to dividend-paying stocks alongside technology stocks likely experienced less severe losses. 2. Income matters during volatile times. Dividend stocks provide income through dividends, which can help cushion the blow during bear markets. This income becomes especially valuable when stock prices are stagnant or declining. 3. Valuation always matters. While high-growth stocks can be enticing, it is crucial to consider whether their valuations are justified. Dividend stocks, often associated with value investing, tend to have more reasonable valuations and provide tangible returns through dividends. 4. Focus on quality. Companies with a history of paying and growing dividends often have strong fundamentals. These companies are more likely to withstand economic downturns, as demonstrated during the dot-com crash. The performance of dividend stocks during the dot-com bubble illustrates their potential as a stabilizing force in an investment portfolio. While they may not deliver the explosive growth seen in speculative sectors during bull markets, their consistency, income potential, and resilience in downturns make them a valuable component of a balanced investment strategy. As today's market shows signs of volatility and speculative behavior, particularly in sectors like technology and cryptocurrencies, the timeless appeal of dividend stocks remains evident. By learning from the past, Investors can build portfolios that not only capture growth but also maintain stability when markets turn rough.